Hey everybody, my name is Jonathan Rose and I want to welcome you to Masters in Trading Live. At Masters in Trading Live, we're going to get on here every single day. We're going to go over the market, and every single day we are going to share our number one trade of the day. Today, we're going to go over the Qs. The QQQs, the NASDAQ, has been making a pretty strong move down to our major line in the sand. After Iran had a sneak attack on Israel, the VIX spiked higher and our line in the sand has been taken out. So we are now under our line in the sand. So the first thing we're going to talk about is the QQQs. The second topic, the market's not always right. It's a weird thing to say. Traders look at the market, and if they buy a stock and it goes up, they make money, they think they're right. The market's not always right. I'm going to expand on that. We saw a blip in the QQQs, and then finally, I'm going to take you to our trade of the day. Let's go over the charts. I got you at the QQQs, and the line in the sand that we've been talking about, and we've been talking about this now for at least 2 weeks. And you can go back, we have every video that you can go watch on YouTube, but the line in the sand is 433. When we talk about a line in the sand, we want one strong level. That one strong level, 433, is right here. You can see big support every single time the Qs drop down. Now that we've fallen through, especially on really powerful news, I want you to look at this 433 as massive resistance, even bigger, gnarly resistance. 433, and watch that VIX curve. We talk about VIX term structure. As that 9-day VIX trades higher, we expect the Qs to trade lower. Not only have the Qs taken out our key line in the sand, but the topic that we've been talking about the most has been VIX term structure. And in front of you, the red line is that VIX 9 days. That's a 9-day measure of volatility. The yellow line is the VIX. It's a 30-day measure of volatility. All these times you see that red is super, super low, especially relative to the yellow. That's because the market is most often predictable over the next 9 days. That's why the red gets so low. The 30 doesn't get as low as the red because over 30 days, there's more uncertainty. 9 days is more predictable. 30 days is less predictable than 9 days. And a year is certainly less predictable. That's why we have so much risk out when we have more time. When the market Qs get under our line in the sand, that's our confirmation. When the VIX starts rallying, not only do we have a confirmation, now I need you to be patient with that position. I need you to be confident with that position because it's the right side of the market. Use that 433 as major resistance. If we put them next to each other, what you'll notice is we take out the line in the sand pretty much or darn close to the same time that that VIX 9D takes out the high of 2024. This is a very bearish move, and it's coupled with world news. VIX. We've been talking about the VIX term structure along with this Qs and the main line in the sand. Well, now look at last week's trading behavior with the VIX. Last week, from April 12th to April 16th, we saw some big, unusual options activity. We call this advance notice of a big move ahead. But if you see April 12th, April 15th, April 12th, April 12th, we saw trades of 2.9 million, 2.6 million, 2 million, 1.2 million. In those 4 days, 24 million in premium was bought on the call side and a paltry sum on the put side. So there's certainly some bullish activity on those risk measures. Couple that with that QQQ line in the sand, and this market is starting to look very heavy and is most likely going to trade lower. April 12th, once I got to see this VIX movement, we sent a warning. Do we need to check in, guys? The water is rising. I'm just saying risk is rising. I bet there's news to come. It's getting worse. Look to buy short-term puts. Now, April 12th, this was before we heard any news about Iran moving on Israel. The market is showing us the news, is showing us that, hey, there's risk in the market. We might not know exactly what that risk is, but when we see that VIX 9-day spike, that's when we send warning. The water is rising. I bet there's news coming out this weekend, and that's exactly what happened. News comes out over the weekend. The market is definitely heavy. Bad, bad, bad. Some members were able to take advantage of the insurance that we suggested. Rick, great job. Now, when you're insuring your account, not every trade is for every person. If you're sitting there and you're long Microsoft, Amazon, and Tesla, you got to hedge your account. You're long 3 names. When the market starts moving, everything has systematic risk. It's called beta. When the market starts moving, everything has got a beta of 1. So somebody long 3 names, yeah, you need insurance. Someone who's short 3 names, you don't need insurance. You know why? Because you don't have anything to insure. You can't buy insurance when there's nothing to insure. That's just speculating on the downside. So great call, Rick. Rick needed some insurance, and he was able to capitalize on that call. Great job, buddy. This happens time and time again. We talk a lot about building your memory bank. And as traders, we see things over and over, and we want to capitalize on them. We don't want to see something again and be like, oh man, I made the same dumb mistake. How did I lose money twice in the same situation? So the week before, going into NFP, non-farm payroll. Guys, do we need insurance? Who needs insurance? You can go back April 4th and watch that video. The trade that we shared, again, buy short-term Qs to protect your account. And here you can see we're able to make 117% and then 280%. If you need insurance, make sure you get in before those VIX spike. Every single day since February 28th, we've been getting on here, sharing 1 trade of the day. Today's trade is going to be on an ADR, an American Depository Receipt. An ADR is a company that is traded outside the US, but they also have an ADR that trades inside the US. Banks aren't looking too good as earnings season starts. I searched all the banks that are available to trade, and only 1 came up with a sell signal on our high value target tool. Here's what that tool looks like. On a weekly, looking at 3 and 4 standard deviation bands, we just look at when the market trades or ING trades outside of its bands, back inside. Same thing on the long side. Right now, we are getting a sell signal. ING is the only bank that I'm getting a weekly sell signal on, and it's an American Depository Receipt, which to me means that volatility, or to me means that market makers probably don't have the best understanding of how to value this company. The trade that I like, earnings are going to be May 2nd. Check your earnings date. I don't want to go in May because volatility is super, super, super cheap. Like stupid cheap, dirt cheap. So instead of going in May, 30% vol, I like these 15 strike. Buying the 15 strike for 80 cents. Now, super important. When you buy an option for 80 cents, you have $80 of risk. You could buy 10 of those, you have $800 of risk. I want you to hold this position for 94 days or until we could take out a big fat profit. And I'll get on here live when we're able to take out that big fat profit. Understand though, when you buy options, you can never lose more than you play, than you bet. So you make that decision about what you're comfortable risking before you ever get into the trade. That's the trade there. Buy 15s for 80 cents. Again, guys, 11 o'clock every single day. I'm going to get on here, go over the market, and we're going to share our very best trade. We like to say the creative trader wins. I want you to look at the market from a different perspective, a different angle. Trade smart. We'll see you tomorrow live, 11 o'clock. Thanks for watching.
Make sure you click the link to catch Jonathan every weekday at live.mastersintrading.com.